I want to get into an overview of NFT sales taxes, just a basic explanation of sales taxes, how sales taxes work, when do they apply to NFTs, and what factors are going to impact the taxability. You see, I've listed some here: underlying product and service, nexus, sourcing, and if these transactions are bundled with other goods or services that you're selling. And then we're going to get, like I said, into the challenges and requirements for collecting and remitting. So let's get into some of the basics here. What are sales taxes? Many of you may be aware of this. I know I'm talking to a group more focused on tax professionals, but sales taxes are a consumption tax that's levied on goods and services. It's usually going to be collected by the seller at the point of sale and then remitted by the seller to a state government. The amount of sales taxes that you're going to collect on any given transaction is going to vary by the state that you're being taxed in, as well as the type of good or service being sold. And there are a number of exemptions that vary again at the state and local level that can exempt some products from being taxed depending on, again, exactly what you're going to sell. So how does sales taxes work? There's a few variables that go into how you're going to calculate the sales taxability for any given transaction. And this is important to understand that at a basic level to see how it's going to apply to NFT transactions. The first thing we have to consider is sourcing the sale. So that basically means understanding what tax jurisdiction is this sale going to fall under. There's different methods to sourcing a sale. I've listed them here: origin, destination, and modified origin. Origin is basically basing the tax jurisdiction based off of the seller's address, where destination is based off of the buyer's address. And modified origin combines these two based off of different factors. So that really is the first variable, is sourcing the sale, understanding what tax jurisdiction this sale takes place in. Then from there, you want to understand, after you understand what tax jurisdiction you take place in, then you want to start to understand, do you have a nexus in that jurisdiction, and are you going to be taxed there? There's many forms of nexus. The two main that I want to focus on are physical and economic. Understand there are more, such as click-through nexus and many others that really are just out of the scope of this initial presentation today. But basically, physical nexus is when you have a physical presence in the state. This could be a warehouse, an office, employees physically located in the state. If you have a physical presence there, it's likely you're going to have a nexus, which means you should be collecting and remitting taxes for sales that are sourced to that tax jurisdiction. Economic is basically, you can have a nexus in states where you don't have a physical nexus that's going to be based off of sales thresholds that are set by that state. Those sales thresholds vary by state, and they can be represented in both dollar amounts and unit thresholds, depending on the state. Some state gives a dollar amount and a unit threshold, some only give a dollar amount. So that will vary. Economic nexus really came as part of the Wayfair court decision that took place back in 2018. And this was really a byproduct of the proliferation of the internet and e-commerce. This was when we really started to see a new way of transacting online, where people are buying products with the click of a button and then getting them shipped sometimes across the country to another state. This is what brought the whole controversy of, do sales taxes apply to interstate sales? And then we got the Wayfair decision, which introduced this concept of economic nexus. So that's where this comes from, is this Wayfair decision. And that's what economic nexus is. If you're selling out of state and you reach certain thresholds, you still can have a nexus there, which means you have to collect sales taxes for that tax jurisdiction. So after you source the sale, you decide if you're taxable based off of your nexus. Then you need to look at the specific product you're selling, the specific NFT you're selling, and we need to determine, is this NFT or is this product that you're selling, is it taxable? So that is like a basic overview of how it works. So now the question becomes, what types of NFTs have sales tax exposure? So right now, it is somewhat limited, the exposure that the guidance that we're getting from states currently regarding what NFTs are exposed to sales taxes. There are some states that have given better guidance than others. And I expect other states to sort of look to this guidance and build upon that. And basically, the biggest states to look towards would be Washington and Minnesota. And they have both taken a look-through approach to NFTs, where Washington, for instance, is taxing standalone digital products, standalone NFTs. That is right now, when we say NFT, that's sort of what you would think about your more traditional NFT. It's intangible art usually. That is, a standalone digital product. So that Washington has given guidance on saying that those are taxable. And then they go on to outline a look-through approach that you'll see here, where the way that they worded is the object of purchase is a standalone good or service, and it's either classified as a retail sale or it's not classified as a retail sale. Meaning you want to look at what this NFT actually represents. Does this NFT represent ticket submission? Does it represent a physical print of a piece of artwork? And then you want to look through at the sales tax regulations related to whatever that product or service is. And if that's taxable in Washington, then the NFT that's associated with that is going to be taxable. Washington also has given guidance regarding royalty payments, which they're going to apply their B&O tax to. Now, in Minnesota, it's somewhat similar, although, their wording is different. The language they use is different, but they're just outlining the fact that NFTs can be a representation of many different products and goods and services. And they basically say that here, these entitled purchasers to receive certain products and services. And then they go on the list, if the NFT represents what's listed here, although this isn't an exhaustive list, that these types of NFTs are going to be taxed. So really, it always is going to come down to the question of the specific NFT that's being sold, and then whether or not taxes apply to that based off of the jurisdiction that it's in. So, okay, what are the factors that are going to impact NFTs? The underlying product or service, like I just mentioned, and like you've seen in this interim guidance from Washington and that from Minnesota on the previous screen, we need to look at what is this NFT? What does it represent? What underlying products, goods, or services does it represent? And we need to consider that in determining the taxability. Bundled transactions. Is this NFT sold as part of a bundled transaction? Meaning, are you selling this NFT along with other products or services, and it's all just one purchase? That can also impact the taxability. And then, of course, as I previously outlined, nexus and sourcing. So we need to look at, do you have a nexus in the state that you're selling to? And before we even determine nexus, we need to determine sourcing to understand where is this transaction, what tax jurisdiction is it going to be taxed, and where is it going to be considered taking place? So now you have a basic overview on, what are sales taxes and what are some of the factors that impact the taxability of NFTs. So now it starts to become, how can we actually start getting clients into compliance with this? Because there are some significant challenges right now, just outside of the regulatory ambiguity, just from a practical standpoint, looking at the guidance that we do have in Washington and Minnesota and other states. How can companies start to get into compliance? Because later we're also going to go over the risks associated with non-compliance, and they can be pretty severe. So some of the challenges that companies are going to face once they even become aware that, there's a sales tax exposure potentially to NFTs that they're selling, is that there's going to have to be certain information that's collected at the point of sale. Mainly for sourcing purposes, we are going to need, in order to get accurate tax rates and in order to properly source the sale to the correct tax region, you're going to need to collect your full customer's address to get what's referred to as rooftop accurate rates. So that is going to me to be like the biggest friction, just like we're seeing the issue right now at the federal level with broker regulations, with Form 8300 and other issues where there is a requirement coming down from regulators to be collecting more information from non-custodial wallets that are interacting with businesses on chain. And this issue is going to extend past some of these federal issues that we're all focused on to sales taxes and this requirement to start collecting the address at mint just so you can even calculate the sales tax. So that's going to be the first problem is that people in this industry value their privacy, their anonymity, and they try to maintain the pseudonymity that's associated with their non-custodial wallets. And now, in order to mint an NFT in a compliant fashion, they may have to start providing more information that gets associated with that wallet. So that to me is going to just be an industry-wide challenge, and something that industry-wide everyone's going to have to navigate. Then collecting sales taxes in the native cryptocurrency. Of course, when we're seeing these transactions, usually they're going to happen in Ethereum or in another altcoin. And after you've sourced the sale and you've calculated the tax, you're going to have to collect that when you're collecting the mint price from the customer. And this is all going to have to be done in a native cryptocurrency. So now you're going to have to be calculating the tax in real time, converting it into whatever the native cryptocurrency is, such as Ethereum, and then collecting that tax in addition to the mint price. And then also managing those tax liabilities on the back end and hopefully not exposing them to validity risk by holding them in whatever asset that you're collecting. Then on top of that, also, you're going to have to start collecting at the point of sale all of the data that's going to be necessary for tax reporting. Now, tax reporting for sales taxes, it varies. It can be monthly, quarterly, or yearly, but you're going to have to collect the appropriate data to be able to file the forms and get into compliance. So that's going to include transaction data from the customer, transaction data from the blockchain, and just transaction data associated with the sale itself. And obviously, all of this needs to be done in a scalable fashion and in an automated fashion, because you could be minting 10,000 NFTs in a day. So all of this needs to take place in a way that provides scalability. So I want to get a little more into state by state, like what we're seeing. I know we touched a little bit on Washington, and Washington right now with their interim guidance really is leading the charge in terms of providing regulatory clarity. But there are other states that have been focused on this and that have provided guidance as well. So I want to just provide a brief overview, state by state, of states where we do have guidance, and then a brief overview of states where we don't have guidance, but with some of the tax risks and future outlook is in terms of future guidance from those states, and just do a comparison between the states. Okay, so Washington, like I said, they have been out in front of this. They were the first to provide guidance with their interim statement that they released in July 1st, 2022. And their interim statement includes legal definitions, specific examples, unlike we've seen in some other states, such as, let's say, Pennsylvania, who we have seen provide some regulatory clarity by adding NFTs to their taxability matrix, but they haven't given any examples yet of NFTs that are taxable or not taxable, or any legal definitions of NFTs. They've really just added NFTs to their taxability matrix. So there is a variability in terms of the guidance that we're getting from states. In Puerto Rico, we haven't gotten guidance. We haven't even really gotten past a proposal to include NFTs in sales taxes in Puerto Rico. So that is something that's pending. And then, we have Wisconsin and Minnesota who have released a tax bulletin in Wisconsin and a fact sheet in Minnesota. Although not as comprehensive as Washington, they provided more information and examples than Pennsylvania, for instance. And in both states, we also see them taking this look-through approach, where you're going to look at what does the underlying NFT represent, as I previously outlined, and then each state has outlined certain examples where this can be taxable. So, for instance, in Wisconsin, if the NFT entitles a purchaser to download music or movies, the sale is taxable as a specified digital good. If it entitles the purchaser to an admission to a sporting event, the NFT is a taxable admission. If the NFT entitles the purchaser to a tangible piece of artwork, it is a taxable tangible personal property. So these are examples, specific examples that we got from Wisconsin. Now, with all these states, we'll get into like how to prepare for this in a little bit, but with all these states, if there's a state that hasn't given you guidance, or a state where the specific examples that they provided in this interim guidance or on their fact sheets or tax bulletins doesn't cover a specific instance for you or for a client, it it makes sense to reach out to that tax department and request clarification from them, possibly request a binding letter of ruling on your specific fact pattern so you can get more clarity for any specific seller of a specific NFT. Minnesota has also given some examples. So again, digital products, they list these as music, audio, visual arts, or video games, admissions to events, tangible personal property such as collectibles. And it also goes on to give some guidance on bundle transactions, sourcing, and non-taxable products. So really Washington, Wisconsin, and Minnesota, I would say, have given the most guidance so far, with Washington being the first and most detailed to date. But what I think is even more interesting is the fact that there's over 30 states that are applying sales taxes to digital products, not to specifically NFTs, but to other digital products. And it's anticipated that sooner or later, they're going to focus more on NFTs and likely include NFTs in the category of digital products, like we've seen Washington and other states. What that guidance will look like, it's hard to say, but we can start to see a trend with these first few states of how the sourcing and how the look through approach and the overall approach to taxing NFTs is going to look for sales tax purposes. So, we'll get into the risks here in a moment, but that's one of the big risks, is basically that these NFTs are getting fit into these categories of digital products and goods in the states that have provided guidance, which means that the taxes can be applied retroactively since the tax regulations related to digital products and goods have been in existence for years. So that can become a problem for NFT sellers that are not compliant right now, because they can have this risk of retroactive taxes related to the sale of digital products in the form of NFTs. So again, there's, going to be a lot of ambiguity on this. So you really want to be careful with following best practices. And that includes, number one, staying up to date on new regulations and tax changes and keeping your clients up to date on this. You don't want to start to overlook new guidance that comes out in a specific state and miss out on registering and properly collecting taxes, because again, that can hurt your bottom line, or it can hurt your company's bottom line. And then it's key that you analyze each NFT sold based off of its underlying attributes and the underlying product that's associated with it. And again, like I said, to the degree that you or a client are operating in a state where you think you do have a sales tax exposure and the current guidance isn't clear, that's when you want to try to be proactive and reach out to the applicable state taxing agency and request clarification from them in some form, possibly through a binding letter ruling or something similar. And then it's key to obviously document your tax positions regarding the taxability or exemptions and base this off of state guidance. And the documentation is key. Obviously, it's hard to get clients to be proactive in their taxes and in their documentation a lot of times just at a basic level when it comes to crypto accounting and taxes. Now, this is going to add a whole new element that we're going to want to be proactive about staying on top of. So now I want to sort of get into my outlook on the future guy. So, like I said, Wayfair itself was really a consequence of the, just to clarify, I'm referring to Washington. When I say Washington, I'm referring to Washington State. I just want to clarify that. So outlook on future guy. So, like I said, with Wayfair, that happened back in 2018. It was really a consequence of the proliferation of e-commerce and people transacting online. It was a new way of commerce that we call e-commerce. As a result, there were the tax regulators had to catch up to technology, which was basically outpacing them. And that's how we saw Wayfair come into play. Now we're basically seeing the second iteration of this with Web3. And as a result of blockchain technology, there's new ways of transacting, new ways of doing business, and NFTs are a direct result of that. And eventually, just like we saw with Wayfair and with e-commerce and with the internet, regulators are going to catch up to this. We're going to get guidance, and likely we're going to see some sort of decision that includes NFTs as taxable in many states. And you could call this Wayfair 2.0 in a way, just as we're in Web 3.0 now. Like I said, over 31 states tax digital products, and it's likely that we'll see them provide guidance on NFTs, because really NFTs in a lot of ways are another form of a digital product. And not this risks extends past just individual NFT sellers, but also to marketplaces. In many states, marketplaces that are selling NFTs are going to be looked at by those states as what's referred to as a marketplace facilitator. And they could have requirements and consequences to non-compliance at the marketplace level, but that also doesn't get the seller off the hook. So, this, as a seller, you also need to be aware of this. But even marketplaces, they're going to have to really focus on getting into compliance with this, because obviously the bulk of sales are happening through these marketplaces, and it's going to possibly become a bottleneck for regulators once we get to an enforcement stage. Yes, closely watching future guidance related to sourcing. This is important. I actually didn't get into this when I was talking about Washington State, but one of the big issues, like I've said, is the fact that in order to get into compliance with sales taxes on chain, you're going to have to start collecting information associated with people not custodial wallets. Specifically, you're going to have to collect their address. And there's going to be friction with that, obviously. And Washington has somewhat addressed this issue in their interim guidance with their sourcing hierarchy, where it's a 5-point sourcing hierarchy, where the last point of it is that if you don't collect the address and you don't have any of the buyer's information, then the sourcing reverts back to the seller's address. So in these instances where a state like Washington once wanted to go and pursue retroactive taxes for someone that didn't properly collect and remit, and they don't have any of their customer information, in that case, based off the sourcing hierarchy, it all would revert back to the seller's address in Washington, and then all the sales would get taxed based off of that tax rate, and then obviously they would be on the hook for them. And this is a huge risk for anyone selling NFTs, because really, as a seller, you should be collecting these sales taxes from the buyer and remitting them to the state. But if you get caught in an instance where you're not doing that, this could come out of your pocket, of course. So it is important that everyone is closely watching future enforcement actions at the marketplace level mainly, and at the individual seller level, but also even at the use tax level for individuals, which is likely going to be less of a focus, at least initially, but is still a potential issue. So let's get into some of the risks of non-compliance. So, some of these I got into, but we'll go over these. Um, First is penalties and interest. So, in addition to having to pay your sales taxes, there can be penalties and interest charged in addition to that you're going to have to pay. So, again, if you're not properly collecting and remitting this as an NFT seller, this all can be coming out of your bottom line. The risk of retroactive applicability, because NFTs are taxed as digital products, at least in the states that we've seen guidance on so far, this opens up the door for retroactive tax applicability, meaning that, someone that sold NFTs during the last cycle could potentially still be on the hook for those taxes if the state wanted to pursue it. And if they set a sourcing hierarchy, like I outlined in Washington, the seller can get stuck on the hook with all of these sales taxes and associated penalties and interest. So accurate record keeping is a must, and just getting into compliance as soon as possible is absolutely key. Um, Additionally, there are other risks, obviously reputational damage, especially for marketplaces, but also for sellers. If you're not complying with these regulations, there can be headlines and just bad, a bad perspective coming out about not, paying their fair share of taxes. And we all know that, on the IRS's website, they're citing a 75% non-compliance rate right now for income taxes. So we really don't need more non-compliance in this space. We want to start to work towards changing that image. So, the reputational damage is another risk. And for the customers that are purchasing NFTs, when sales taxes aren't properly collected, really should be paying use taxes on those. Obviously, this varies state to state, but there is the risk of that as well. Although, if history is any teacher, use taxes I haven't seen get enforced that much as sales taxes. They're going to target the sellers in the marketplaces more likely. But this is all happening on an immutable ledger, all these transactions. So a little bit more on use taxes. So NFT customers who purchase NFTs for sellers, like I said, who did not register to collect the sales taxes, may be liable for use taxes. So this would basically be them having to pay the sales taxes on their personal tax return when they file at the state level. So to the degree that they don't do this, they could run into tax issues. And could you imagine a scenario where someone is running into tax issues as a result of a seller that's non-compliant? What that would do to that seller's reputation, whether it's an individual seller, a company, or a marketplace, that would not be a good scenario at all. So, that's something else that needs to be considered. And this is the biggest risk to me, and this is why I'm going to keep harping on this, is the retroactive applicability. Because there's a lot of companies right now who, have successfully sold NFTs in the past, and they could potentially be on the hook for taxes associated with this. And obviously, as we move into a new cycle, if we see NFTs get another resurgence, there could be a whole nother cycle of successful NFT sales that are done non-compliant and creating this huge risk of retroactive applicability. So right now, the way that we've seen NFTs be added to the taxability in these states, Washington, Pennsylvania, and Minnesota, retroactive taxes are something that is something that is on the line for sellers that are within these states. And again, I want to stress the sourcing hierarchy, because that, even if you haven't collected the customer's addresses, all those sales can get sourced to the state in which the seller is operating in which case they can become on the hook for all of those sales. And again, there's over 31 states that tax digital goods that likely will include NFTs into this, and then also open up this retroactive taxability. So this is a challenging issue for the Web3 industry in general, because there is a lot of challenges to sellers even properly collecting and remitting this and getting into compliance. And there's so much regulatory ambiguity. But then on the back end of this, there's a huge tax risk associated with it once we get into the definitions and how this retroactive applicability is. So obviously, like anything in crypto taxes, record keeping is absolutely key. We need to be able to substantiate every transaction that we do on chain. So businesses that sell NFTs must keep accurate records of all sales transactions, and this includes the date of the sale, the amount of the sale, the customer's address, the type of NFT that was sold, and they must also keep records of all the sales taxes that were collected and remitted. And then these must be accurately filed with the applicable tax agencies. And you're going to have to report all this information about the sales transactions, how much tax was collected and remitted. And obviously, you want to stay in compliance with those filings, but the first step is just getting this information. So accurate record keeping and reporting and collecting and remitting is how you're going to avoid all of the issues that I outlined. So that's why this is key. So now that we understand some of the, just an overview on, how do sales taxes apply to NFTs? What are sales taxes? What are some of the types of NFTs that are taxable and the risk associated with it? Now we need to start to understand what are some of the best practices for NFT sales tax compliance. First, you really want to start determining where do you have tax exposure. And like I said, a lot of that comes down to sourcing and nexus. So that is going to be your first challenge. Again, I know we sort of hit on that already, so I'm not going to belabor it, but you want to be ideally, collecting the right information so you have the right sourcing on all of your transactions. If you're not collecting this information, you need to look at the state that you're operating in and see if they have guidance like Washington, because this all can still revert back to your state in that case. So the first step is you need to be properly considering your sources and nexus to understand where do you have tax exposure. And then based off of that, you need to make sure that you have clarification for your specific NFT and its taxability within that tax jurisdiction. So, that's when you need to look at, do you have a nexus in Washington? Do you have nexus in states that have provided guidance, or do you have nexus in states that haven't provided guidance? If you have nexus in states that have provided guidance and their examples and guidance fit exactly with your NFTs, you may be able to go off of that, or you may want to contact the state agency and still get clarification on your specific fact pattern, possibly getting a binding letter ruling from them so you understand confidently whether or not you should be collecting and remitting sales taxes. Once you have a tax exposure in the state, you're going to have to register for sales taxes. And once you register, then that's going to create the ability for you to actually start collecting sales taxes when it's taxable from your customers and remitting them as appropriate to the state sales tax agencies. So those are really your first steps. And then in order to do that, like I said, you're going to have to keep accurate records. You're going to have to collect all of the information, including the date of sale, the amount of sale, the customer's address, the seller's address, the type of NFT that was sold. All of this information is going to have to be collected, and a lot of it is going to have to be remitted when you're filing your tax forms. And another thing, obviously, is to consult with a tax advisor, or if you are a tax advisor, make your clients aware that this issue exists. The way that I came across this issue was working with uh NFT artist that was having a lot of success about a year or two back. Time flies now, so I don't remember exactly when, maybe a year or so. But they were having success and actually expanding beyond just selling NFTs and tangible artwork, and expanding to selling physical prints as well. And that's what sort of led me down this whole sales tax rabbit hole, is basically just making them aware through, when we were doing some tax planning with them, that they're going to have sales taxes applicable to their prints. And then the questions of NFTs started to arise in my mind, and I started to research. And that was right around the time where Washington's interim guidance was coming out. And I've been sort of staying on this topic since then, because to me, this feels like crypto taxes in 2016. No one's really focusing on it. No one's aware of it. No one really knows how to properly get into compliance due to just a lot of roadblocks that we've previously outlined. So, you want to be that advisor that's proactive with your clients and making them aware of these emerging issues. So you can be viewed as that strategic advisor to them that's on top of these new issues, and hopefully help them protect their bottom line by getting them into compliance. You want to also consider using software solutions to automate portions or all of this process in terms of the initial collection of the initial calculations, to the collection of your customer information, to the reporting. And I can't stress enough about being proactive. Businesses need to be proactive and stay up to date on the changing sales tax laws related to NFTs and really all transactions on chain. And this is where, as a tax advisor, a CPA, a CFO, you can add value by keeping them up to date on these topics and hopefully helping them get into compliance and avoid interest and penalties, reputational damage, and anything else that could potentially come of a lack of compliance.